Okay, we're live.
It's us.
Yes. I'd like to make a note that all members are here today. We also have our city attorney, Charles Finkenbinder, Pat Moon with Meridian Investments also. And did everyone get a copy of the September 14th minutes? Any changes to the minutes?
I'll move to approve.
Second.
All in favor?
Aye.
Pat, would you like to go first?
Sure. Were you wondering if I showed up today?
We know where
We
to find
believed
you.
you. Rain or shine, I'm going to come, as you know. I would like to have a copy, if I could, of the actuarial report. I'd like to see that.
I think I got an email of it. I'm
Okay,
sure.
yeah, I'd just like to keep up with that, see kind of what some of the things you're thinking about, if you need some input ever. Well, the plan's down 20% for the first 9 months of this year. You know, I wish I could point all to the stock market, and if I did, different parts of the stock market are down, kind of starting at 25%, and you know, some markets are down as much as 40%. It's been pretty nasty start to the year. There have been only 3 years since World War II where the market was finished the year down 20% or more. Only 3. So this one could very well be the 4th. I wrote down, you know, I mean, I like to be optimistic about anything that I can, but I wrote down what the following year return was in each of those 3 years. And in 1972, the following year, it was up 31.5%. In 2002, it was up 26.4%. And 2008, it was up 23.5%. So eventually the market kind of works and then starts looking at forward things. And of course, we don't know what those forward things are, but things eventually look better. I'll start in on your packet here. And of course, on page 1, this is one of those pages you kind of have to look at it and focus a little bit. But the purpose of this is I've shown it to you in different pieces in the past. It ranks in that return of these different asset classes by year. So in 2007, on the far left, that EM equity, that's emerging markets stocks, they were up 39.8%. Commodities were up 16%. Developed market international up 11.6%. So it just shows you by year the range. And then on the very far right, it shows you the annualized what was done best since 2007. So what we're going to look at is this year-to-date column over on the far right. So year-to-date, commodities are up 18%. Now you think about commodities, that's energy, you know, food, copper, and those things. Those things are definitely up this year. Cash doesn't rank second very often, but it is today. And then fixed income, those are bonds, down 14.8%. Worst year in the bond market in our history. And a lot of things going on across the world. England is having to step in and buy their own treasuries. They call them gilts right now. There's really this total dysfunction in the bond market that's gone down. High yield bonds down 18%. And then you can start getting down to stocks, large cap, that's S&P 500 down 23, small cap 23.5, emerging markets 26 and 26, and REITs, that's real estate, down 31%. So pretty ugly numbers there where we are today. So let's talk about a few of those.
What's the white
things.
box? Is that us?
The white box is just below you. The white box is 60% stocks and 40% bonds. You're generally 70 to 75% stocks and the rest in bonds. So I'm glad you pointed that out. One of the uses of this chart, I should have said it before you pointed it out, is the benefits of diversification, asset allocation, of owning, you know, a little piece of the middle so that you don't have the extremes and you get really 60% of the return with less than half the risk there. On page 2, you know, everybody's looking at the economy, and it is different this time. And by different, I don't mean business cycles. We have business cycles all the time. I don't mean even bad news. We have bad news all the time, and it happens. It affects the market. What's different this time is the amount of government spending that we've had in the way of outlays over the last 2 or 3 years. The Federal Reserve has flooded the world with money, and the purpose of that was to prop up, you know, our economy and the world economy. And then our government propped up our economy by making stimulus payments. In my opinion, most of them were needed to a lot of places, but did that anyway. That costs that causes a lot of problems down the road. So that's what's different this time, is all this money's gone out in the world, and now Federal Reserves all over the world are trying to pull it back. Because what it amounted to is it made inflation, you can't just add a whole bunch of everything without inflation going up. So this economy is general domestic product, gross domestic product on the top left. The top, you see the big jagged, that was the 1 quarter recession that we had when COVID first came in, but you can see the economy's cracked there at the top. And the last 2 quarters, it actually shrank just a little bit. Whether that means we're in a recession or not, they don't really define those things until after you look back and say, yeah, we were in a recession. But who knows? So it shrank just a little bit in the first 2 quarters, but we're still above where we were this time last year. So if we are in a recession, it's very, very mild so far. And so we got this fiscal drag. That's what I'm talking about. Federal Reserve removing the stimulus, less government payouts, surge in mortgage rates. 30-year mortgage rates now are above 7%.
Wow.
So if you take somebody buying a $400,000 house last year, and then their payment with what interest rates were last year, which were 3% or below, and you say, well, what would it cost to own a $400,000 home at 7%? The house payment more than doubles for the same price house. So eventually, and it doesn't take double, people can't afford that house. They can't afford to get in that house. So the housing market, in my opinion, is in for some pretty dire times. Dire, that's too big a word, but it's going to be tough in real estate for a while. And then the strengthening dollar. So unemployment, the reason I put unemployment down here, it's 3.5%. We've never had a recession with employment this strong. So that's one of the things that's working for us. We're beginning to see some layoffs, but we're not seeing these massive layoffs everywhere, these companies letting people go because business is bad. Maybe it happens, I don't know. But we've never had a recession with uninflation at 3.5%. So that's one thing that's really, really working for us especially going into the Christmas season. On page 3, I wanted to kind of give you a picture of interest rates and what the Federal Reserve is doing. So what's happened, they've raised rates dramatically and are going to continue to do it, probably even again this week. But this chart on the top shows the level of interest rates now and a year ago. And so the bottom line is by maturity. So a 3-month, 1 year, 2 years. So for example, the 10-year a year ago, the interest rate was 1.52%. The 20-year, 1.94. Well, look where they are today. A 10-year is 3.89. It's actually closer to 4 today. And short-term rates have really exploded there. So their rates are going up, and the Federal Reserve is controlling most of that. And the reason they're doing it is this inflation. And on this bottom left-hand chart, I just wanted to show you what inflation's running. It's running at 8.5%. It comes out again this afternoon or tomorrow, the rate. And everybody's really wondering, is it going to be 8.5% or worse or less? And if it's the same or more, and maybe just a little bit less, the Federal Reserve is going to continue ticking rates up. So the things that are sticky are the bottom ones, like restaurants, hotels, transportation, shelter. That's not only sticky, it's still going up. Those wages are starting to go up because of inflation and unemployment being so low. Those once you pay somebody a bigger wage, you can't go back and say the consumer price index went down this year, so we're going to take it away from you. That's not the way the world works. It doesn't.
No.
But the energy and used vehicles and food, maybe some food, those could be things that come down fairly quickly under the right circumstances. So,
Do you think the feds have raised rates too high, too fast?
No, we just very rarely in our history we've seen inflation at 9%. Yeah, so they're purposefully trying to shut the economy down. They're not saying it just like that, but they are saying it. And it's got worse. This time a year ago, they said, this is all transitory. No problem. It's going to be fine.
Yeah.
Well, it's not fine, and what we found out. So they're having to react pretty quickly because it's not coming down yet. Yeah. So the prime rate of interest, currently, the prime rate is 6.25%. So you got to be, if you're doing a business loan, your best rate now would be 6.25% if you were their best customer, but most people pay a little above prime. So you can just imagine, all kinds of loans, not just home loans, all kinds of loans going up. on page 4, this is a picture of the stock market at the top left. I've shown you this. So the 14-year bull market is over. You can see how it's tipped over at the top, down 24% year to date. That little blue line up there, faint blue line, I added that. That's mine. So that means the chart is mine if I added to it. I just did that to say, well, if the trend were still going where we were, that where the stock market was a couple weeks ago, it's probably okay. Not really overvalued, but we've come down below that. So I think there's a good chance that the market holds here and doesn't go down 35%. But we'll see about that. I will say the bottom left-hand chart shows the average price earnings ratio, which is the value of the market. It's not expensive. It's not cheap. It's about average. So very rarely are we at average. We usually overshoot one way or the other. So we'll see if we bounce from there, or we go on through and the stock market continue to go down. And lastly, about that, in the top left, this is company earnings. And company earnings last year surged and grew 70%. So that's why the stock market recovered from COVID and went up 18% and 20%. And almost 30% in those 3 years is because earnings were recovering. Well, the last one on the right there, it shows you earnings are just essentially have been revised for this year down to no growth. No growth. One of the things I heard recently about, like we're coming into the Christmas season, you notice that Amazon is doing a pre-sale on their Amazon Day. Maybe that's already started, I don't know. But what happened to retailers, and Walmart is a really good example of this, Target too. When we were having so much trouble getting stuff shipped over here, they over-ordered. Mm-hmm. They ordered a whole bunch of inventory so that they could catch up. Well, all of a sudden, COVID kind of lifted per se, and people weren't buying stuff anymore. They were traveling or getting out or whatever. And so retailers are awash in inventory. And so if you're a buyer, it's going to be a really good Christmas season because there's going to be a lot of things marked down from that. But that hurts companies' earnings, and that's one of the things that we're kind of worried about there.
Christmas stuff at Hobby Lobby is already 50% off.
I think it was in July too. Yeah. Hobby Lobby, yeah, there's something. If you ever want to buy a Christmas a picture frame 50% off, they're always 50% off.
Let's go to Hobby Lobby on Tuesday.
To you, yeah. The last thing I want to leave you with is a little bit of good news. Is it's in our business, it's kind of psychologically we tend to do the wrong thing at the wrong time. We get the most discouraged when things have already turned or about to, and vice versa. This is Consumer Sentiment Index, which is how you and I feel really about what things are going on. And all these things that are happening, there's a lot of them, the pandemic and inflation and stock prices down now. And the war, we haven't dealt with that much lately. We're a full participant in that. But the markets look ahead, and this shows consumer sentiment going back to 1971, and the dots above the dashed line are when they peaked, and the dots on the bottom are when it bottomed. So I just wanted to show you, look at this red box I made up here at the top left. The average 12-month stock market return for the next 12 months at the peaks was 4.1% over the next 12 months. At the bottoms, the troughs where we are now, the average return for the stock market going to 71 is 24.9%. So even though we are where we are, the stock market will look beyond that and we'll start recovering before we feel better. And we just hope it happens before our next meeting, so I don't have to use all the same material. Well, page 6 shows you the numbers of the plan, and you can see for the quarter, the plan was down. That quarter number is not right. I'll get back to you on that. I'm not sure where the minus 12% because that's not right. I'm sorry about that. But the year-to-date number is right. It's down 20%. And look what it's done to the long-term numbers. I was showing you, 8 and even a 10% long-term number there up until this happened. Mm-hmm. And you can see those have rolled off there. Looking at the components, the middle part is the bonds and the stocks. Those quarterly numbers are correct. You can see your bond portfolio has held up pretty well against the Treasury market, which is the safest market, down 8.9% year to date, about in line with government. If you were in more corporate bonds, it'd be down about 13-14%. And then for the stocks, you can see your stock portfolio actually has held in a little bit better than the market in the last quarter, down 2.1%, SP 500 down 4.9. International stocks have started to go down again, and they've hurt us in the past, they're hurting us now. And then you look year to date in 1 year and everything's down big over there to the right. And then, Tyler, I know you keep up with the market value. You've got the kind of this mental running. We haven't seen the 12,000,008 in a long time.
Mhm.
Yeah. You know,
That's one thing we talked about after GRS was here and gave their presentation. Those numbers are, after what's happened since
Yeah, it was
January.
based on 16
Yeah.
million or close to it, wasn't it? I think it was.
yeah.
after what's happened since January, that you can see what liabilities and stuff still are, but as far as funding of the plan, those projections are now out the door.
Yeah.
Based on what
Yeah.
the losses that we've seen.
One of the things about those actuarial studies is it takes a long time for this information, a 1 year's information, to kind of show up in long-term projections. So next year, if you were to get a report, it won't show a dramatic difference than it was this year. If we did this for a long period of time, it would start showing up
Right.
there. But, I was here when, before you had the current plan and before they were doing an actuarial study, and I suggested that they do one. And your plan is it's feasible. I know it kind of seems like a lot of money. It is a lot, but it's structured now in a way. Y'all done a good job. You're going to dig out of that. We may all not be serving in our current roles when you get to that point. You're doing a good thing.
Yeah, the optimistic outlook is that in any of their, graphs that they give us, they go out usually about 30 years. Even at 30 years, those lines are still trending upward.
Yeah. So you're out of the danger zone.
Yeah.
Because they were trending down.
Yeah.
You're at it. As long as you keep them going up, you've got a viable plan. And believe it or not, your plan's in a lot better shape than a lot of municipalities, especially in larger cities. On page 7, I want to make a couple of remarks about the way this pie chart looks like. We're starting to buy more bonds because now we're getting above 5% on bonds. A year ago, we were getting 1.2. So, if we can lock in, maybe not getting to 40% of your portfolio in bonds, but if we can get 30% or 35% locked in at 5 or 6%, that's prudent. And, to have that lock that in for whatever number of years we can get that. And then you've got less foreign stocks than you've had in quite some time. It got as high as 30-something, so we've cut back some there. And then those large and mid stocks are about the same. You do have quite a bit of cash. We don't come in here with 7% very often. So in certain markets like 2020, when the market went down 34% in 3 weeks, y'all probably don't remember that, but it was March 15th through the
You
April
remember
about the
exactly
7th.
what
Yeah. The same period of time I didn't sleep at all. But, when something like that happens as a portfolio manager, as a team, when we get together, it's really obvious that there's things to buy. I mean, things just get ridiculously cheap, and you say that's a no-brainer. I don't know exactly when we're going to make money, but we did, and we did. This kind of market is different in that everything's kind of going down at the same time. Now, there are all those unprofitable companies that have been doing so well over the last 5 years. They're gone. I mean, if they're still alive, they're down 70, 80, 90%. We avoided all that. But there's nothing that looks, based on where we are today, that's just a no-brainer. We need to be buying that. So it's a little bit more difficult in our situation right now. But anyway, that cash has a purpose. It's dry powder to buy something. We just haven't had the great confidence to take it to 1 or 2% at this point yet. I told Lisa, I send her a monthly report statement to give to you, and we did a system conversion. We went live October the 1st. I don't recommend it. We were on the same system for over, I don't know, maybe 15 years, and so we're having some real growing
You
pains.
just figure out how to,
Yeah.
Yeah.
Just the kind of basic things like how to print off a holdings report. That's accurate. So I included it here, Lisa, in the back here, as your handout to them. In the future, this report is going to look like, I'm going to report monthly, not just the holdings, but it'll also have a performance on each monthly report, so that y'all can talk about me when I'm out at the other meetings, I guess. But it'll have kind of the pie chart, asset allocation, the returns for that month and year or whatever, and then the assets. Lisa, do you use the client portal? Do you use the client portal, our client portal?
I have.
Maybe once a year or something like that.
Whichever one I used to get statements.
Yeah, that's it. It's new, so you would have gotten an email in the last.
Oh, I did.
couple
I got an
weeks.
email. I think I got a letter.
Okay, yeah,
Yeah.
so if you want to get back into that. This new portal.
I forwarded you the presentation that they
Thank
gave us. So.
Thank you.
And and if you want the
Hard copy
If you
of
want
that.
the full, is that the full actuary report or just their slides?
I think it was just their slides.
I can send you the full.
I'd like to see that, but yeah.
Just the slides.
That's plenty.
Kind of has their recommendations and
Well,
to get to 100% funded, which we will not shoot for,
Yeah.
but mostly because of what you described, that we're staying ahead of it now.
100%, it really isn't even desirable. There's no reason to get to 100% as long as you got this entity that's operating and regular cash flow and coming in. Really, if you could get to 70 to 75%, that would probably be it. They're not going to say that. This is just me saying this. That would be adequate to have a healthy plan that doesn't have an end.
I think by the end of their timeline, and I don't know if that shows on the slides. I want to say 30 years out, they had us at about 53%.
Yeah, they have us at 38.5 right now.
38.5
That was
right
back
now.
at the other.
But it also had you running out of money in the 30.
Yeah, and it doesn't have us running
Before
now.
Before you change.
Yeah.
Completely, running out
Going
of money.
broke.
Well, and part of that was taking that interest money
Have to
a
look.
little bit. Yeah, that was a little bit. I'm
Yeah.
looking out. So they have it 2050.
But yeah, their suggestion was that we raise city contributions to 14%
Mm-hmm. Mm-hmm.
from 10,
Yeah.
which dollar-wise it's real money.
Mm-hmm.
And we were kind of talking before they presented to council, and the mayor was like, well, what do you think our goal should be? Because I kind of said the same thing, that would be to get us to 100% funded, which is just not necessary. And he said, well, where do you think we should be? And I kind of thought about it, and before I looked at it, I was thinking 50. Like if we could get to 50% funded,
Mm-hmm.
I think that's a realistic goal and a decent place to shoot for. And then I went back and dug into to the full actuary, and sure enough, and I can't remember if it was 20 or 30 years out, but their projections show us getting a little over 50. So I was like,
Yeah, they put different rates in here, and they said the 14, we'd get there about 2050.
Yeah.
But if we did 10%, we wouldn't get there, but we'd still be ahead. So one note for you, Pat, is they make the assumption of a 6.5% investment return.
Right.
So
So this year, that was looking pretty,
Yeah.
we could do that. The way the
We'd be
markets
happy
have
with
done
that.
over time,
yeah,
and the way it's invested, that's a very, very reasonable assumption.
and then from my seat, I don't ever want to say, no, let's don't do anything. And then in 10 years, we're back to,
yeah.
oh, we should have done something. But if their projections show us, like I said again, on that upward trend headed towards 50% funded and even getting better after that, I also have a hard time saying, yeah, we need to throw more money into the plan too.
Well, but you're good at keeping us informed about the cash flow issue, are we covering, what we're having to pay out?
Right.
And I think as long as we have a nice cushion there also.
Yeah, and that's
It's kind of
another-
watching a multiple of things.
That's another kind of conclusion I came to is like, yeah, liability is going up, but so is the funded ratio. I said, I wish we could give you more money. We haven't
Mhm.
contributed to the investments in
Mhm.
a long time.
Long time.
And that's the cash flow.
Yeah. And not to get to the point where we pull anything out, as
Right.
long as we can handle it without, then that can still continue to grow over
Mhm.
time.
So you're not, at this point, considering any different funding changes? You just take a note and y'all will be thinking about it over time?
I'm trying to remember from that, and I think the consensus I got from the council was they don't want to raise the employee rates at all. That we might want to budget an actual cash payment in each year, and then also look at the end of each year, because we've ended with some nice positive net income over the past few years. So it really would just come out of our fund balance, especially after we pay back and have all our reserve in there. So we have a reserve fund. So once that gets to the 2 million, then, what we put about 500,000 in that every year, just to get it caught back up, didn't
250.
250. Okay, so that might be available then to
Yeah, I
put
think
towards this.
everybody.
I mean, there's a lot of options, and it would probably be a mixture.
I think the council as a whole was more receptive to those one-time
Because it's flexible.
cash
Yeah.
influxes. however-
Take advantage in the up times, and that's why I was asking about sales tax. As long as sales tax remains strong, we can do that without impacting employees or even our budget, overall. Take advantage of that ahead of, other larger downturns.
And I think they could probably correlate with their projections.
Mhm.
So, as long as their projections are upward, then on good years, we could put some more money in the plan.
Yeah.
If the projections start to turn downward, then I think we may.
Then we'd have to look at other options.
That
But
city contribution rate and raising that up.
The employee contribution, is it 8%?
It's at 10
10
for
the employee.
for the non-grandfathered. So if you're hired after May 1, 2018, you're paying 10. Before that, you're paying 6.
Okay, and the city's putting in 10.
The city's putting in 10 for everybody.
The funding that they're recommending that would put it more in line with this big state pension funds like APERS and ASHERS and teacher retirement.
Yeah, we're paying 15 point something on APERS for our 2 participants that we have. I guess we're just having one. I
We have
don't
two.
think Kim's in it.
Is she? I thought she was. I'll have to look again.
I think she opted out.
Did she opt out?
But nonetheless, our APERS rate is like 15.3 or something like that.
But we only have 2 employees that could even be in that plan.
Yeah. I see, interesting. Well, the fact that you're on the trajectory that you are is, in another way, remarkable. I don't know if you remember this, but the actuarial assumption used to be 8%. And so when they hit it that high, they're assuming you make 8%, so they're assuming that you have to put in less. Now they're assuming that the rate's 6.5%. This has been going on both through legislation and the actuarial community really pushing for it. And it's probably a good thing, but the 6.5 makes it the hurdle higher to fund a plan. So some of the dire projections you got were backward when we were using 8%.
Wow.
So you're really ahead more really of where you might think by just reading the report, because it's more, the requirements are more stringent measurements. So, well, I look forward to getting that. I don't know what I'll do with it, but I will read it. If anything comes up I want to comment about, I'll do it.
Okay.
All right. Well, thank you for your time. Good to see you all.
Coming. Look for better news in January.
Yeah, me too. Me too.
A great Christmas season, right?
Yeah.
And we got our rain for the fall in a few minutes.
Yeah.
So,
I was excited there for a while.
So hopefully it's not over.
Yep.
We have several requests for refunds.
This is the.
That's the outdoors.
Either way.
Jacob Hurst, $1,108.91. John Melton, $8,528.73. Ryan Warren, $15,160.93. And Leah Dawn Voorhees, $31,211.95. Leah's husband passed away, and she's requesting that his contributions be approved.
Was that from sanitation? Is that
Yes.
right? I'll make a motion to approve.
So,
All in favor?
Aye.
Motion carries. I also have one employee from district court that has submitted a letter to, she wishes to retire. Leah Darling, she wishes to retire, effective yesterday, in fact. Yesterday was her last day. So her retirement will start today. She has been with district court since 2009, and with her, gives her over 13 years of service, and she meets the age requirements also, so she is eligible. Her gross monthly pension amount will be $1,375.04.
I make a motion to approve.
Second.
All in favor?
Aye.
Does anyone have any new business they want to
Make a motion to adjourn.
Second.
All right. All in favor?
Aye.
Thank y'all.